Hello everyone, welcome back to fourth part of our corporate action series. So today we are diving into one of the most impactful event in the business world, that is mergers and acquisitions. So whether you are a finance professional or just curious about corporate finance, understanding mergers and acquisition is essential. So let's break it down. First thing first, what are mergers and acquisitions? A merger occurs when two companies combine to form a new entity. The goal is usually to create synergy where combined company becomes stronger than the two separate ones. For example, think of Disney and Pixar merger. Together they became the animation powerhouse. On the other hand side, we have an acquisition. So acquisition happens when the company buys another and absorbs its operations. So in this case, the target company ceases to exist as an independent entity, but the acquiring company often takes the advantage of acquired company's resources, market presence, or technology. A classic example is Facebook's acquisition of Instagram. Now, why do companies go for mergers and acquisition? So there are several reasons, and here are some key ones. Number one, market expansion. So companies may merge or acquire to enter new markets. So this helps them to overcome the entry barriers, whether geographic or regulatory. Second one is cost synergy. So by merging, companies often reduce the cost by eliminating the redundant roles or the optimizing operations. Point number 3 is diversification. To reduce the risk, company may acquire another form of a different industry. So this spreads the risk across the various business line. Point number 4, increased market power. So with the bigger market share, company has more power to negotiate with the suppliers, compete effectively, and even influence the pricing in the industry. Point number 5, access to the new technologies. So often tech driven acquisition happens so companies can leverage innovations they don't already have. When we talk about mergers, there are different types of mergers. First one is horizontal mergers. So this occurs between companies in the same industry. So the primary purpose is to reduce the competition and increase the market share. For instance, merger between Vodafone and Idea in India. It is the great example of horizontal merger in the telecom industry. Second type of a merger is vertical mergers. So this happens between the companies at the different stage of the supply chain. For example, if a car manufacturer merges with the tire supplier, it's a vertical merger. So this type of merger helps streamline the production and reduce the cost. Third one is conglomerate mergers. So this occurs when the company in the entirely different industries merge. For instance, if food company merges with the tech company, it is considered as a conglomerate. So the goal here is to diversify the business operations and reduce the risk. So what happens after an mergers and acquisition deal is announced? For instance, these corporate actions often cause big price swing in the stock market. So let's look at how different players are affected. First player, for shareholders, let's say. So if you are a shareholders in the target company, the acquisition can lead to increase in the share value, as acquiring company might offer a premium price to buy the target company. But beware. Now all mergers and acquisitions are not beneficial. Sometimes shareholders of the acquiring company may see a drop in their stock value if the market feels the price paid is too high, or deal might not be profitable. Second is for employees. Employees for both companies are directly impacted. So in some cases, mergers result in the layoffs due to job redundancies. On the flip side, New opportunities may arise in terms of resources, career growth, and development. Third one is for the market. So mergers and acquisition can shake up the entire industries. For instance, a major acquisitions in the tech sector may force competition or competitors to rethink their strategies, which can drive innovation or lead to the further consolidations. Now let's bring this to the life with a real world example. A recent example of Amazon acquisition of Whole Foods. When Amazon acquired the Whole Foods for $13.7 billion, it wasn't just the entire entering into grocery market. It was about leveraging the Whole Foods physical location to enhance Amazon's delivery network and transform how people shop for the groceries. So lastly, let's talk about the process behind the mergers or acquisition. First is planning. So both companies conduct extensive due diligence and assess the financial, market positions and cultural fit. Then second is negotiation. The two companies negotiate terms including the purchase price and any changes in the management or operations. Third is approvals. So shareholders and the regulatory body must approve the deal to enter or ensure it's in everyone's best interest and doesn't lead to the monopoly. And fourth is integration. So after the deal close, the real work begins. So integration or integrating these two companies, operations, cultures and strategies, that is for the long-term success. So that's the wrap of on the part 4 of our corporate action series. So mergers and acquisition can be a complex, but they are the crucial part of the corporate world and offer tremendous opportunities